Hello, everyone. I'm John, lead analyst and founder of JP Strategic Investments, and today I'm going to talk to you about whether or not you should use a traditional IRA or a Roth IRA. And the answer might surprise you, so let's dive right in. So first of all, I'm going to quickly summarize how an IRA works, the difference between traditional and Roth IRAs, and the pros and cons, and then we'll get into why we think you should probably actually use a traditional and a Roth IRA as opposed to just one or the other. So first of all, an IRA is an individual retirement account. IRAs are brokerage accounts in which you can buy and sell stocks, mutual funds, and ETFs, although they have some restrictions. First, the money that you deposit or contribute into an IRA must be taxable income, and there are limits to how much money you can contribute each year. The limit this year is currently $6,000 for anyone under the age of 50 and $7,000 for anyone over the age of 50. Also, any money that you contribute into the account, along with any gains from the investments, generally can't be withdrawn until you reach the age of 59 and a half. Withdrawing the money early is possible, but there are often taxes and penalties involved. So, what are the advantages of an IRA if there are all these restrictions? Well, it has to do with taxes, and that's where we get into the difference between traditional and Roth IRAs. So first, let's take a look at traditional IRAs. So with a traditional IRA, the money that you contribute to the account is contributed pre-tax, meaning that it is deducted from your taxable income. This can be very beneficial because it allows you to put more money away for retirement. For example, if you had a taxable income of $50,000 this year, but you contributed $5,000 to your traditional IRA, then you would only be taxed on $45,000 for this year. The catch is that the money is then taxed later when you withdraw the money. The idea with a traditional IRA is that it allows you to put more money into your retirement savings earlier, which will then allow you to make more money from your investments. Plus, there is a possibility that you will be in a lower tax bracket when you retire, so the withdrawals might actually be taxed at a lower percentage than they would have been taxed when you contributed the money. A Roth IRA, on the other hand, does the opposite. Unlike with traditional IRAs, you still pay taxes on your contributions, but later when you withdraw the money along with any capital gains from your investments, you can withdraw that money tax-free. The general rule is that if you think you will be in a higher tax bracket when you retire, then you should go with a Roth. But if you think you will be in a lower tax bracket when you retire, then you should go with a traditional. In our opinion, though, the best thing to do is to actually have both a traditional and a Roth IRA. And here's why. Every year when you pay taxes, you get deductions. You may take the standard deduction, which is currently $12,000 for filing single and $24,000 for filing married, or you can itemize. Either way, you're going to get at least the standard deduction even after you retire. So what this means is you can actually withdraw up to that $12,000 or $24,000 from your traditional IRA each year when you retire tax-free. This is because the money that you withdraw from your traditional IRA that would normally be taxable income is now negated by the standard deduction. This way the money is never taxed because it wasn't taxed when you made the contribution, and now it's not being taxed when you're withdrawing the money. Then you would just pull the remaining money that you needed each year out of your Roth IRA, and assuming that those are your only sources of income, you would never have to pay income tax again. So the question is, how much should you contribute to each IRA? Well, if we assume that most people use the standard deduction when they retire, and that the average retirement age is 65, then most single people should contribute about $1,000 to their traditional IRAs each year, and most married people should contribute about $2,000. Assuming average market returns, this would most likely give you enough money to withdraw the standard deduction amount from your traditional IRA from the time that you retired until the time that you were 95 years old. The remaining money that you contribute can either be added to your traditional as well or to your Roth depending on your current tax situation. Essentially, if you think you will be in a lower tax bracket at retirement, contribute the extra money to your traditional. But if you think you will be in a higher tax bracket when you retire, contribute it to your Roth. Keep in mind though that your tax rate can change over the years as your income fluctuates. So if, for example, right now you may be getting taxed at a lower tax rate than what you think you will be getting taxed at when you retire, this could change over the years. You could get a raise, you could get a new job that then increases your income, you could get a bonus at work, or maybe there's just one year where you take an extra side job to make a little extra money. During those years, that extra income could be getting taxed at a much higher tax rate than what you would be getting taxed at when you retire. So during those years, you can contribute more to your traditional IRA so that that money is now not taxed when you contribute it, and then when you pull it out under the standard deduction, it won't be taxed either. On the other hand, if you do have years where maybe you don't make as much money, then those might be good years to contribute more to your Roth IRA. For these reasons, it's always good to have a Roth and a traditional IRA so that you can take advantage of every situation and make the most out of your tax deductions. We hope we explained this well and that it'll help you navigate the complicated world of retirement accounts. If you found this video helpful, please consider liking and subscribing, and have a great day.